Hello and a warm welcome to Personal Finance. I'm Gugulethu, Cele. Now, we all want to improve our endeavors when it comes to saving and investing more money, but how does your risk profile play into this, and what are the key considerations that you need to be aware of before going out and investing and saving in products which may have a strong implication on your risk profile? Joining me now for more perspective is Stephan Buys. He's the Head of Strategic Business Development for F&B Savings and Investments. Good to have you with us today, Stephan.
Thank you for having me.
Let's talk about risk, because I think it's one of those clear things that everybody hears about and we think we have a clear understanding of it, but what kind of role does it play when it comes to one's saving and investment initiatives?
Well, I want to start off by saying that a lot of people, when they talk about savings or investments and risk and those things, they often want to run for the hills because they think it's a very complicated thing. Risk in its simplest form is just about what you as a person can actually afford from a money perspective. So when it comes to savings, it's quite simple. When making an investment choice, it's how long can you commit the money for, and also the type of instrument that you can put the money into, because some types of financial instruments would actually carry more risk. And what we mean with that is you might lose some of your capital, or your return that you earn on the product might not be secured. But when it comes to simple savings products and committing your funds for a specific period, it's more about understanding what type of expenses that you need to pay for in the near future, because that's going to depend how long you can actually put that money away for. So within the broader portfolio investment kind of world, when we talk about risk in that regard, it's slightly different. It's not so much about affordability, but it's more about the risk that you as a person can take, and that depends from person to person. For some people, their personality types is that they're gamblers, they want to take a lot of risks, they want to win big. Other people want to know that they've got a secure capital growth, or that they're earning secure returns from the product. So their risk profile might look totally different than people that are willing to take a lot of risk.
And I take it this also changes depending on the various life stage that you're at.
Oh, definitely.
Single and in your 20s, a lot less responsibilities. You might be happy to take on a lot more risk versus someone in their 40s, right?
Yes, most definitely. So people in the early parts of their working career can take more risk, and normally from a portfolio perspective, people are then advised to take more risk in like their pension fund savings. When they do make investments, they can take on a bit more risk, because typically their investment horizon is a lot longer. They can recover from losses. People that are nearing retirement or have just gone into retirement, the typical advice to those investors or savers are that you need to put your money into something more secure, at least where your capital is secure, and you're earning a stable growth from that. A lot of these people also need to live off the income that the investment return, so for them it's very important that they know what they're going to be earning off the investment.
Risk versus reward, it's a term that I heard about many years ago when I was doing my studies, but it obviously is a relationship between the two. For the average person out there who might look to save or have some kind of investment, how do they monitor the two and in choosing the appropriate products in which to invest in? Or is this where you need some kind of a financial advisor or financial professional to assist you in making such decisions?
Financial advisors are always a good idea. They can assist. It also largely depends on your own financial understanding of financial terms and financial jargon and how comfortable you are with those things. But it is actually quite simple. So when it comes to risk and return, it starts off with something very simple, and it's almost a bit of a rhetorical statement to make, but it's understanding your expenses, understanding the things that you need to spend money on a monthly basis to survive, the amount that you can actually afford to save and put away for those rainy days or emergencies, or maybe something specific that you're saving for, like a holiday overseas or whatever it might be. But the risk-reward thing always comes back to understanding where your money is and what you need to use it for. When there's enough money that you've got put away in an investment, then the risk-return conversation becomes slightly different. Then it's about what we just spoke about understanding how you can commit it, how long you can commit it, and also then the type of the risk that you're willing to take in that thing. Are you willing to lose some of your capital? Are you willing to not have a secure income, but in the long term maybe gaining quite a bit off it? So I think there's no simple recipe to these kind of things. It's understanding your own finances, I think also in the context of what's happening in the economy. We need to be aware of things like interest rates might possibly rise, what those things might mean for our cash flow on a weekly basis or on a monthly basis. Because a lot of people forget that when interest rates starts going up, your cash flow is going to be a bit less, especially if you've got quite a bit of debt that you need to service, home loans, vehicle finance, those kind of things. So it's not a simple answer. It's something where you need to take a lot of factors into consideration, and that's why I say sometimes if you struggle with those things, a financial advisor might be somebody good to speak to.
I take it investment goals are clearly what need to be established here, because many people consider what savings more for the short to medium term, and maybe shouldn't go too risky there, versus the investments, which might be for 5 to 10 to even 15-year outlook.
Yes, typically investments are those kind of things that are deemed for long term, where capital is tied up for quite a bit of time, and also when capital is taken up, there might be some penalties. So it is something where the commitment is a lot longer. But also the type of instrument or the type of vehicle that you use to put that money into, also actually it's to your benefit the longer you keep it in those things. Equity markets typically don't do so well in the short term, but over a 5 to even 10-year period, these instruments typically tend to do very well. So it's you don't want to put savings money into a share where you're paying quite a bit of fees and cost to actually originate the investment, and then having to take the money back in a month or a half when the market has moved downward. Yes, the market will correct in time and it will grow, but it's understanding the difference between things that you're going to need in the near future and things that you actually can part for a longer while with.
And that brings us to, I want us to use FNB as an example, because you have several products and innovations available to consumers where they can either save for the short term or even invest for the long term. But there's also the element of tax-free savings accounts. Yes. In your interactions with some of your clients and the feedback that you get from the floor, what are the key nuances that people look out for when they want to save or invest, and where they often make typical mistakes?
So I think in South Africa, the collective investment schemes have become quite popular. It's an instrument that you can put money into very easily, and you can also have access to the money quite easily. But people need to be careful to understand, as I've just stated, that those funds are heavily invested in shares or debt instruments, and typically those things perform better over the long term. So if you know that you're going to need money in the short term, you might find that the 100 Rand that you put in there might now be worth 95 Rand because the investment did not have proper time to actually grow and get capital appreciation. What we do find where people are very glad, and I'm glad you mentioned the tax-free savings, is we've seen some excellent responses to that, and people are definitely putting money in there, opening these accounts for their children as well. For those people that don't know, it's something that you can open for children as well. It's a wonderful way of accumulating a nice lump sum of money that would not be taxed. So any return earned off that would actually in time be to their benefit, because they're not going to pay the tax on those things. Yeah. But a great initiative from our government to actually step up and present or offer these things to the South African market. I think the whole industry is quite excited to have it as a product that we can also offer as part of the bouquet of products that we already offer.
I'm happy you touched on the element of children, because one would think that, oh, they can take on all the risks necessary. They've got, as you alluded to earlier, a longer time frame to find a correction and make that loss back up. But for people who are pensioners, or maybe have a 10-year outlook on their remainder of life, how much more risk can they take? Is that even an option for them, where they can look at potential investment or savings vehicles which have slightly more risk, just to beef up whatever kind of returns they would make?
So I think the advances within the financial industry has lent itself to products where capital can be secured, but your return might take on some risk. So the fact that if you put 100 Rand in there, you will be assured of getting your 100 Rand back, but your return on the product might not be guaranteed. And in that regard, customers can take a bit of risk in terms of their return to maybe earn more than what they would earn on your typical bank savings products. So these products that I refer to are structured products. They're also on offer in the market. Sometimes they get wrapped a bit because people don't understand them so much, but it's a wonderful product to also look at in time. But I definitely think the way that the market has matured and the way that it's regulated, the way that these products get sold to customers, if it's somebody that does not have a long investment or deposit horizon, there are products that would definitely suit that need. It's just about making sure you understand the product features and the benefits, and you don't put money into products that's going to tie you for 10 years if you need the money next week. So again, it's about information and understanding what is offered to you.
Time now to get a quick recap of this evening's conversation. Stephan, from your perspective, the key takeaway points that one needs to remember when it comes to risk and how it impacts on your savings and investment initiatives.
As I've stated earlier, very simple: understand the expenses, understand your own budget, have goals for those things so that you know what you can actually put away and what you can save. When it comes to risk specific to investment products, understand how long your money will be tied up, understand what the underlying asset or vehicle is that the money will go into so that you can understand exactly what it is that you're getting yourself into. And also I think then the last important point for me is that there are quite a few products out there that you can invest in. If you're unsure, speak to advisors, pick up the phone. Call centers are there to assist people to make choices. So make sure that the need that you have is matched by the product that you take up.
Perfect. So one needs to clearly get the advice and understand the implications thereof. Thank you so much for your time today and for giving us a broader perspective of risk and the impact that it has on your savings and investment initiatives. Well, that's where we leave it for Personal Finance this evening. Do be sure to get in touch with us via Twitter using our account at CNBC Africa, #Finance410, or contacting myself directly with @Gugulethu. Until next time, though, do be sure to stay with us. But from myself and the team, have a wonderful evening.